Hello, my Pixel peeps. Welcome back. Nicole Payne, CMA, here as always to drop some accounting truth bombs. And today, by special request, is another episode of Accountantese. Now, today I actually had somebody call me out on the fact that I keep using this term GAAP. And no, I'm not talking about the store that you can go to down at the shopping mall. I am talking about generally accepted accounting principles. Now, accepted accounting principles, or GAAP as we call it, are the standards and guidelines, principles that dictate how we in the United States do accounting and how we account for different things. Pretty straightforward, right? I mean, it makes sense that accountants use accounting standards to do accounting. Um, but I do want to make sure to mention that these standards, principles, GAAP is very specific to the United States. So that if you are doing any kind of international business, there are completely different standards. I mean, they're not completely different. It's just they differ in slightly for businesses that are operating outside of the United States. Those standards are called IFRS, the International Financial Regulatory Standards. Now, you may wonder why, if we're doing accounting for my company, why do I have to follow GAAP? Why do I have to be GAAP compliant? And for the most part, it's mainly for two reasons. One, the fact that the IRS requires that you report things very, very specifically for tax purposes. And the other is in the event that you are looking for financing, whether you're going to finance a big purchase like a vehicle or equipment, or if you want a loan for working capital or a line of credit from a bank, they are going to expect you to provide financial reports that are in line with GAAP. And they do it so that they can be comparing apples to apples rather than apples to oranges. As we all know, apples and oranges, not the same thing. So they standardized, the powers that be standardized how accounting was done so that they had consistent reporting across multiple companies, across multiple entities, so that they could create these standards for comparing purposes. Because they want to know how creditworthy you are. They want to know what your going concern is. All of these things feed into whether or not you're going to get financing. And they also, obviously, the IRS is just kind of this nebulous power that controls all things in the United States when it comes to money. And so they have a little bit of say, a little bit of pull in how you make sure you're taking care of your money. Don't have to like it to have to live by it. Anyway, I hope that clears things up. As always, it's probably clear as mud. If you have any questions or comments, anything that I have ever said that you think, hey, can you clarify what that means? Drop it in the comments or shoot me an email. My contact information's on the last slide. And until next time, take care, everybody. We'll talk soon.